Yo, what's up, everybody? It's Matthew Mickey here. And before I really get into today's class, I want to talk about myself, right? So, and the commitment that it takes to learn this stuff. All right. So, look at this picture right here. This is they call it the Bluff. I live literally 5 minutes from here, and the significance of the Bluff is it's in Brooklyn, New York, and it's the place where the first shots fired through cannon at British ships took place for the Revolutionary War. All right. And look, I live right over here, right to the left of that playground. All right. So I sit here and I learn this stuff, and I use this green notebook and I take notes, or I'm in my favorite spot, which is a picture of me right. And I sit in my car every morning and I take notes, or I sit in my car every night and record a video. You see, we're taught in the military, there's no excuse not to accomplish a mission, you find a way, right? So we have to think outside the box of how to, right? Why don't I do it in my office? Well, my office is where work happens, right? Why don't I do it at home? Well, there's 4 women living in my house. It's impossible to do. All right, so we know that I'm putting these videos together for my daughter, my grandkids, to look back and reflect their grandfather, their father, and his life studies, right? And his passions, right? You got to find the driver. You got to find the discipline, right? And the person who gave me the best advice ever was Oliver Kell, and he was the world equities trading champion in 2020. He said, Mick, trading's hard work. You got to put the grind in. It's as simple as that. It's hard as fuck, right? So what are you doing discipline to find your edge? Because we're not from the business. Nobody's going to teach us this stuff. You have to read books. You have to pay money for courses, and you have to put it all together. You have to take notes. You have to learn it. Just like you had to learn and memorize the material for the E5 or E6 or E7 board. In the case, I think the Navy does boards for E7s. But are you getting your grind in? Are you be aggressive. Be aggressive, get your grind in. Don't find an excuse, find a way. And then take that and develop a system that works for you and only you, right? Because there's no exact science to this. It's up to the individual and how they think, how they operate to make the best returns based off the plan that they built for themselves. All right, so get aggressive and rock the fuck up. Let's go into today's class. So the last class, I gave you an overview on the PE ratio, and that is the first step during idea generation, during the quantitative phase that I take, right? This is after I have a macroeconomic bias and a Federal Reserve bias, right? So I showed you I want to find the positive and negative outliers within the sector, right? So there's 2 ways that we can see valuations. It's through the PE or through the PEGs, right? So what is PEG? So the PEG ratio is another valuation of the stock and builds on the standard PE ratio by forward earning growth, right? So we know to find the PE ratio, which is how much investors are willing to spend or sell, based off of that price, right? So to find the PE ratio, we know stock price divided by the EPS, earnings per share, equals the PE ratio. Now, we take the forward PE ratio that we just figured out, and we divide that by the forward earning growth, and we get the PEG ratio. And the PEG ratio represents the price the market is willing to pay a company's forecasted EPS growth. So let's do an example real quick so we can see the importance of what we can pull out of this data. So the stock price is $10 per share. The forward EPS is $1. So we know that $10 per share divided by the 1, which is the forward EPS, gives us the ratio of the PE ratio of a 10-time multiplier. So 10-time multiplier. Now the EPS growth is 20%, right? So now we can take that PE ratio of 10 times divided by the 20% EPS growth, and we get a 0.5, right? And this tells us our PEG ratio. Now, let's use the PEG formula to work out some awesome information that we could use that would be very helpful for us as investors. And the beauty behind this is once you get your template set up, Excel will do all the math for you. And all you have to do is learn the importance of what each thing means. And you only have to learn that one time. And this will increase your probability of being in the right stock, right? So lastly, why PEGs is important to me, right? So let's say a company announces a material change to their business conditions and lowers their EPS from $1 to 90 cents, right? Well, now we have to find last year's EPS first. And we do this by discounting this year's expected EPS. So $1 plus our forward growth, which is 20%. So that'd be $1.20. So we take that dollar, we divide it by $1.20, and we get 83 cents, right? That's last year's EPS, right? Or you can just Google it. It's the same, right? Now, we need to see, they changed the EPS from $1 to 90 cents. We need to see where it will go, where the price is going, right? So we take the 90 cent minus last year's EPS, which is 83 cents, and we divide it by the 80. So we minus them. So 90 minus 83, and then we divide it by that 83, and we get 8%, right? So we know that we're gonna slow 8%, right? So now we take that 90 cents and we divide it by that 8%, and we get 0.5, right? So now is how we get the price of where the stock will go if it uses the PEG constant ratio, right? We take that 0.5, we multiply it by the 8, we multiply that by the 90, and we get $3.60, and that's from $10. So we know that the stock will fall based off this material change to will fall $6.40 due to this to a price of $3.60, right? And now we can see the sensitivity of price and valuation. We can use this to project upside and downside of our trades. So pause the video, rewind the video, figure out what I just did before moving forward, because it'll make, if you understand that concept and you practice it a couple times with a couple stocks, it'll make this whole process so much easier of what I'm about to go into. All right, we know money likes growth, and it is highly the reason for a high PE valuation. Investors and traders are willing to pay the premium because in some way the stock has superior growth to its sector's counterparts, right? Likewise, it's highly likely that the lower PE stocks relative to sector peers, traders are willing to sell at a discount because in some way the stock has inferior growth to the sector's counterpart, right? And so the main reason of growth that we use as a tool in the quantitative phase are forward earnings growth, forward revenue growth, forward PE ratio, and forward PEG ratios, right? So try to remember this every time you look at any kind of data that has to do with PE, earnings growth, PEG, and revenue growth. There is always a reason why the stock trades on premium or discount to its sector peers. Every single time. Every time you look at the data, I want you to say, what is the reason? And what you'll find that in vast majority of the cases, it's due to having some kind of superior or inferior earnings growth. Of course, there'll be exceptions, but we have to focus on the majority of scenarios for now. Like, we'll dig down into how to figure out if that's the case in future classes. So, like I said, I have 8 concussions, 6 from IEDs, 1 from airborne jump, and 1 from getting hit by a car, right? There is no excuse for you not to pause the video and learn this stuff, right? So, now let's do a deeper dive into the first quantitative, evaluation that we do and compare this stuff, right? So the first thing we do is we have to find the outliers within the sectors. And to do that, we have to filter the PE1 and see what the market likes and what the market doesn't like, right? Number 2, we separate market caps. This shows us the maturity and growth, right? Like, is the company still growing? Is it a large cap? Is it a medium cap? Or is it already mature and is a mega cap, right? Then after that, I filter by earnings growth 1, then earnings growth 2, to find out if the market's rewarding or punishing them for the earnings growth, right? And then I rank them by earnings growth 1 and 2, and we can see clear as day that the companies are being rewarded or punished for the earnings and revenue, right? Then I focus on the revenue growth, right? And that's the steps that I take. And I'm not even taking a trade yet. I just told you the steps. Now we're about to walk through those steps and look at live stocks, right? That I did, for teaching purposes, I cherry picked the shit out of it, and I'm looking back in hindsight because it's the easiest way to teach and it is the clearest way to teach. Like, go do it yourself if you need live, learn how to do it and do it yourself, right? But don't text me and be like, oh, you're fake, you're cherry picking, blah, blah, blah. Yeah, I'm fake. I'm not from Goldman Sachs. Like, I'm learning this shit myself. So don't harass me with that bullshit. And if that comes in your mind, then just leave, because I don't need you. This isn't for you. This is for my grandkids and my daughter. But anyway, moving on. All right, remember step 1, find the PE outliers in the sectors by filtering that, right? Step 2, market cap is a big thing. It shows us the maturity of that company in the growth cycle and the business cycle. Step 3, filter by earnings growth 1 and 2. Is the market rewarding or punishing? Step 4, rank the earnings growth 1 and 2. All right, so let's do it for real now. All right, so I take my sector classifications from the NAICS, and that's only because, like, when I'm looking at the ISM World, surveys that come out for the manufacturer and service indexes, like, I pull a lot of trade ideas from there, so I want my data to sync from that as well, right? So I filtered by PE1, and I started finding outliers, right? And here's the outliers that I found so far. I found Shopify, Wayfair, and Overstock. Shopify has a 287, Wayfair has a 125, and Overstock has a 67 PE, right? And I need to understand what is driving this valuation, right? Like, why is, it's trading at such a high multiplier, right? All right. And then now, what we're going to do is we're going to filter by earnings growth. For this to all be a leading indicator, everything has to be a forward-looking indicator, right? All right, so we see in earnings growth that Shopify is negative 22.22, Wayfair is negative 54, and Overstock is 7%. So the earnings growth percentage is different, and why? Their earnings growth is either flat or negative. Like, why are they trading on a high PE ratio multiplier, right? Why? There's always a reason, and it's our job to find out. So now let's filter earnings growth 2 and see if we can dig deeper. And so now we can see Wayfair and Overstock have much higher earnings growth, right? So the higher premium PE multiplier is because investors are looking through the current year and paying premium for next year. That's why it's trading so shitty right now. Like, keep being curious and ask, right? It was because the year for EPS 1, which feeds everything, was 2020. So what happened? Why Shopify is trading on high premium PE when earnings growth sucks? There's always a reason. So now for Shopify, like, you want to answer, they have shitty earnings growth. There has to be something. Well, now let's look at the revenue. So Google Shopify investors relationship and go to that site. It'll tell you all this, right? So now let's look. Maybe they are purposely reinvesting a large portion of their earnings back into the business to grow the top line. At this stage, we just don't know, so we have to dig deeper. Like, if they are doing that, we'll see that later in the phases during the management operation plan. We also see that Shopify has the largest market cap out of these 3, right? And I'll do a class on this later because market cap is like a huge thing that I focus on as well, right? All right, so now let's look at the basic quantitative numbers of the Shopify, and we're going to look from 2012 to 2020 with forecast of 21 and 22, right? So we can see that cost revenue came in at 1.5 billion with an 85% change, right? The cost of revenue was 1.3 billion and the gross profits was 1.58, with operation being 1.4 billion, right? And then as we look, operation income, pre-tax, adjust for and with the gap, and then we look at the research and development, right? And then we look at the forward-looking projection revenue growth, and what do we see here? The picture should start painting it. Like, we should start seeing a picture now, right? So, like, we saw that revenue projections for Shopify was 37% in the current year and 31% next year, right? Revenue is forecasted to be $4 billion in 2021. We note that the cost of revenue was $1.3 billion. The operating expenses was $1.4 billion, right? Equaling $2.79 billion to make the $2.9 billion revenue, right? So 2.7, which is the cost to make, right, divided by the actual revenue is 2.9 equals 95. They're spending 95 cents to make $1. We see that the research and development makes up $543 million of a total cost of $543 million divided by that 2.79, which is the cost of operations. Like, we divide those two and we see that research and development alone is 19% of the cost that makes the revenue, right? So now let's take that 19% and multiply it by our 95 cents cost of operation, right? And it equals 18 cents. So of every $1 revenue spent, 18 of that cents is spent on research and development. Like, this tells me where they're in the growth and business phase, right? This is important information because, like, let's think of it like this. Like, once they move out of this maturity phase, you know, we can take the market cap, which is 112 shares issued, and take that by that 543 million that the R&D makes up, divide the two, and we get $4.84 a share. So once they get done with the growth stage, we know that the price will raise $4.84. Like, we're trying to target those kind of areas, right? So the extraordinary revenue growth in 2020, was due to COVID-19, and the revenue growth for 21 and 22 that's being forecasted is firstly to keep growing the company because the company is going to keep growing at a faster pace, but also rewarding this company because post COVID-19, it had very low numbers, and then because of COVID-19, it was able to boost and turn the company around, and so now they're going to reward it with that by trading on a higher PE ratio, and because they know now maybe COVID-19 was the boost that this company needed to completely blow up, and mature. Right, so now let's look at Wayfair. Wayfair revenue growth is currently at 54%, and it's to drop massively next year, but then it's supposed to grow again in 2 more years, right? Look at the gross profit, look at the operating income, look at all of it. And if you don't know what something means on this slide, then Google it, write it down. What I see is that the revenue growth was 54% in 2020. Forward-looking analysts say Wayfair will be 12% in the current year and 20% the next year. Revenue is forecasted to be $15.8 billion in 21, right? We note that the cost of revenue in 2020 was $10 billion, plus operating costs of $3.7 billion, equaling $13.78 billion to make up a $14.1 billion revenue, right? So we do the same thing. $13 billion, which is the cost of revenue, divided by $14 billion, which is the revenue, we get 97. We know that they're spending 97 cents to make $1. They have no research and development spent, which tells us the business cycle they're in. They might be mature. They jump revenue growth in 2020 because they were down before COVID-19, and the revenue growth in 21 and 22 is forecasted to first keep growing against the potential bold projections and to be lower than pre-COVID levels, right? So bottom line is that they're going from a loss company prior to 2020 to making small profits in 2020 and forecasting to lose money in 21 but making profit in 22, right? So the market is overlooking 21's earnings slump, which is the current year, and paying a premium now for the revenues and earnings growth that they're going to see in 22, right? Therefore, potentially giving them the benefit of 22 revenues and earnings growth now. Right, so now let's look at overstock, right? The revenue growth was 74% in 20. Forward-looking analysts project that 3.9 in the current year and 15% next year, right? The 15% revenue growth forecast in 22 is higher than all previous years to COVID-19. All right, so revenue forecast to be $2.6 billion in 21. We note that the cost of revenue was $1.9 billion plus operating $54 million equals $2.5 billion to make a revenue of $2.549 billion, right? So 2.51 cost of operations to make the revenue divided by the actual revenue is 98 cents. They are spending 98 cents to make $1, right? And they're spending 137 million. Add that, divide that by the operating cost, 5%. They're spending 5% of the revenue on research and development. That tells us where they're at in the growth cycle, right? There's 41 million shares that are issued, so 41 divided by the 137, $3.34 of shares will open up once they leave the research and development phase. Right, so we see that Shopify and Overstock have research and development spent. This is how much it's going to, once they're done with that phase, this is how much the price will go up. We have no RNS. Wayfair has no research and development spend. And then so, as you can see, like you want to focus on this as well, right? Because it tells you how much increase you're going to get once they move out of this phase of the business model. So now, like I'm going to take the last step, the market cap divided by the revenue, right? It shows me something's going on with Shopify, right? Why is the market paying 35 times for 4 billion forward revenues at Shopify and only 1 time multiplier for overstock and only 2 times over multiplier for wafer? Like, is the market wrong? What does the market know that I don't know is the question you should be asking. It could be because of additional quantitative metrics or quality factors, right? It might be worth continuing at this stage to investigate why Shopify has high revenue multipliers and PEs in order to see what the market rewards in this sector. Clue, it is how they make their revenue. Check in the financial statement, sales and services revenue, and others revenues, and compare it to wafer and overstock. But to know this, you have to be curious and look for their answers, right? Which I teach you further on in the course how to find those answers. So lastly, what is a good level versus a bad level of earning growth? Just because a company has negative EPS, loses money, doesn't mean it's a short. Companies like Shop and Overstock lost money for years at the EPS levels because they were growing the top line by plowing revenue out of research and development spend, right? When you go through your process, you have to interpret data and figure out what's a good and bad to identify both positive and negative outliers, right? Part of this process is filtering the earnings growth. So what is a good and a bad level of earnings growth? This can be measured on a relative and absolute basis. You can easily work out the average. The mean average is consistent earnings growth for a sector by just dividing it by the number of stocks in the sector. You would then be able to see the positive and negative outliers, right? However, this comes with one caveat. Absolute earning growths also matter. Like if you find the average of the sector is negative and the most positive outliers have earning growth of say 5%, why would we want to be long a stock that barely has earning growth above the rate of inflation? Let's say inflation is 5%, like we don't, right? So the way I teach it is we want to be long great stocks that go up and short bad stocks that go down in a 20-60 time day horizon. There are obviously better longs out there than stocks with 5% earnings growth, right? So now let's talk about the process, right? And then we'll end this class. I promise. I know it's been a long one, right? And we talked about a lot of information. What we have shown you here is the process that you go through when analyzing the most important fundamentals in a sector to identify potential long ideas or shorts, right? We systematically went through the PE, earnings growth, market cap, revenue growth, and started interpreting the data and digging deeper to try and find answers, right? We're looking for fundamental tailwinds, right? The answer we want is yes or no as to whether overstock is a fundamental buy at this moment in time. Of course, things change in the future, and overstock is just an example. Don't be a dummy and try to buy overstock right now because we definitely aren't in that market. It's not even an idea or even a trade. I'm just focusing on the overliers within the sector, right? The exercise we went through with research and development spending applies in this sector because it's obviously important for this sector. Maybe I don't do it for other sectors. How do we know this? Because the valuations are telling us that it's not just about earnings in this sector. So we have to look at revenue growth and the progression to maturity, right? However, the process we went through identifies the fundamentals to focus on. Remember, everything I taught you in this video is forward-looking. Now in the next videos, we would talk about lagging indicators that come from a fundamental basis. All right, hopefully this helped. Later.